Today is the 3rd of April 2025. My name is Harald Runke and I'm a professor of the Business School of the University of Applied Sciences. My subject is taxation and finance. I'm going to talk about a topic. I've made some research work about it. And the topic is the secret logic of capitalism. This is written in 2024 and had the object of being understandable for everyone who has a general education and the interest to understand the core aspects of capitalism without higher mathematics, but with logic. However, in its center, you find some formulas, but which should also be understandable with general education. For a text about this topic, it is relatively short and only has as much redundancy as necessary to make it understandable. The introduction will give you first insights into the topic and the reason and objective of this little book. I cite Andrew Lay, 2024. The secret of our discipline is that the most powerful insights come from a handful of big ideas that anyone can comprehend. End of citation. Andrew Lay, 2024. When you are interested in knowledge about and scientific literature of capitalism, you can find numerous serious books and articles over centuries which can lead to a better understanding of capitalism. However, different to natural sciences, which is independent of any culture, the science of capitalism is rooted in human culture, as capitalism is created by man and differently structured all over the world in times. And so also the books and literature give different perspectives and explanations of capitalism. Shortly said, whatever pre-opinion you have about capitalism, you probably find the text which confirms your idea of it. And this is a real scientific problem. As with science, we want to find a kind of truth, or better to write with Karl Popper's hypothesis, for which the possibility of negation exists but still not be found. But what would be the hypothesis which would be decisive for the logic and understanding of capitalism? I claim and must explain, respectively, make plausible assumptions that the almost permanent growth of the capitalistic economies is the fundamental effect of the secret logic of capitalism. But what is this logic? As the logic of capitalism not only enables the in-depth understanding of permanent growth, but also explains the foundation of the general accepted notion that the permanent growth of economies is a fundamental problem for nature and our structures of life for Homo sapiens. But why do I use the word secret in the title and once in the introduction? As my analysis of literature about capitalism, historical and present, goes, I cannot find explicitly the explanation for our times of the logic of capitalism, which is explaining crystal clear the first cause of its logic, but the writings about capitalism often present very well accentuated a lot of reasons which, in my view, are only second or third causes of the functioning of the capitalistic system. And this, in the end, is a big problem when we are looking for solutions to make capitalism functioning better for nature and humans. As in physics, when one uses a scientific approach to understand the world we recognize better, one always goes back the cause-effect line to understand the world now. Through this reasoning and scientific studies, series experiments, one concluded that the universe started with a Big Bang hypothesis. And everyone knows that the cause-effect logic is not always valid, e.g. quantum physics, as in postmodernism, it is analyzed too, e.g. Derrida, for language studies. I'm convinced that for the first in-depth understanding of capitalism, the strict cause-effect line helps and is necessary, and so I do. However, no experiments, as in physics, one can do, but hardly not in economics, but statistical data and research results of the other region I will use to support my arguments. The starting point of my research consideration was to examine, in the trust sense, what the deployment of capital in a capitalistic economic system is fundamentally about. Additionally, I'm concerned with the present day, as it is easy to imagine that capital deployment in earlier times was governed by different principles than those of today's digitalized capital markets, where capital can be deployed repeatedly in nanoseconds, globally and in real time. In my considerations, the term capital development or capital refers to investments in productive enterprises, those contributing to the GDP of an economy or the global economies through the sale of goods and or services. With the accelerating progress of the Industrial Revolution at the beginning of the 19th century, the world economy entered a phase of continuous growth, fluctuating and occasionally negative due to major crises, but on average positive over the years since then. By growth, we mean the increase in the production and sale of goods and services, in other words, the gross domestic product of any economy, here referring to the combined GDP of all economies worldwide. This growth is evidently linked to the increase in the world population since the 18th century, or beginning of the 19th century, better to say, and to the rise in productivity over this period, resulting in a continual increase in the quantity and quality of goods and services produced, expressed as the combined gross domestic product, GDP, of individual nations. At the same time, this growth had thus far been accompanied by a continuous rise in energy consumption. Historically and currently, this growth has occurred almost entirely in capitalist-oriented economic systems, including since the 1980s, the People's Republic of China. Notable exceptions for this development include China from the founding of the People's Republic in 1949 until 1978, the Soviet-controlled sphere, influence area of the former Soviet Union from 1970 to 1991, and the Republic of India from independence in 1947 until 1991, which followed socialist structures and a form of planned economy, so that we cannot call these phases based on a capitalistic system. So roughly 80% of global social product and its growth are concentrated in the regions of developed countries' economies. North America, Europe, parts of the Indian subcontinent, Southeast Asia and East Asia, including especially China, Taiwan, South Korea and Japan. Consequently, all impacts critically associated with economic growth, especially climate change, biodiversity loss and resource depletion, are also situated there. There is no end to this growth in sight. The major themes just mentioned, the economic development of national economies over time and their impact and social and ecological processes and structures, are extensively documented and evidence-based in the academic literature. I want to give one example. That's the actual book Growth from Daniel Susskind, and also reflect to the Robert Solow model of growth, and later on the endogenous model, not exogenous like Robert Solow, from Paul Romer, 1990, and there are a lot of others too who took part in these researches. So just to mention that I build up on these for you as a side information. Methodologically, my approach is to derive the functioning of economic activity in a capitalist economic system logically and consistently from fundamental economic principles, without unnecessary redundancy, to uncover the fundamental basis of economic activity. This may sound ambitious, but in the extensive literature I've reviewed so far, I found neither any contradiction to this approach nor this approach itself. I even tested the history here of literature with AI. The basis of this study is a capitalist economic system, particularly in its present form, a system in which investments are made, production is carried out, and products and services are sold through capital markets. The organization of such markets and the techniques employed have changed significantly since the beginning of the Industrial Revolution, and they are constantly evolving due to competition and investment pressures, driven thus far by technological advancement and now increasingly by data processing progress, namely digitalization. This complexity makes it difficult to identify the fundamental mechanism driving these changes, often resulting in rather general statements such as humanity's tendency to strive for more, or, in my view, the erroneous attribution of everything to a single principle, so-called profit maximization. Profit maximization, often assumed to be the ultimate goal of capitalist economic activity, can contradict itself when applied as an argument. Maximizing profit implies an optimal point of profit level. If this level is insufficient, then despite maximization, nothing has truly been achieved. Rather, it is about reaching a certain profit level to satisfy capital investors, and then about continual profit growth to keep investors engaged. This, however, leads to a principle quite different from simple profit maximization. But what is it that holds the inner workings of this capitalist economic structure together, to lose the peripheries good as Faust? Profit growth appears to be a fundamental element, but it must continually develop. Otherwise, rational investors would withdraw. It is therefore necessary to demonstrate why perpetual profit growth is key to solving the puzzle. Karl Marx may provide further insight here, and I quote the famous Marx researcher Kohei Saito. Quote, "Capitalism is a system in which new markets are continuously developed for the purpose of value enhancement and capital accumulation. Marx calls this process the boundless movement of capital, in quotation marks. It is in the nature of capitalism that economic growth for profit enhancement never ceases." Quote ended. Here we find the concept pair, constant and value enhancement, which seemed conceptually linkable to perpetual profit growth, although this has not yet been logically derived from what has been presented so far. Ulrike Herrmann, a German famous writer about the crisis of capitalism, unfortunately does not provide further insight when she states, "One answer is that growth can only arise if loans are taken out, but these loans can only be repaid if there is further growth. It is no coincidence that capitalism is also a money economy. It is driven by credit." Quote finished. While it is financially correct that credit is necessary to enable growth, it is also conceivable that loans are simply taken on a rolling basis, leading not to an increase in goods and services, but merely to the maintenance of constant production levels. And when Martin Binswanger, a Swiss researcher of capitalism, explains, quote, "In order to sustain profits over time, when companies use part of their profits to finance further net investments, growth is needed. This growth is made possible because bank creates additional money through lending, without money creation, an increase in investment must lead to a decrease in consumption. As long as every increase in investment is coupled with a reduction in consumption, the economy cannot grow. Quote ended. The question still remains as to why these growth-oriented credit finance investments should be carried out at all. A compulsion to grow is not apparent here, either macroeconomically or microeconomic. And Robert Solow, the father of neoclassical growth theory, also comments, as quoted by Binswanger, quote, "There is no reason why capitalism could not survive with slow growth or even without growth at all. I think it is entirely possible that economic growth might not continue indefinitely in the same way. There is no intrinsic reason why an economy should not remain happily in a stationary state." Quote finished, quoted from Stahl by Binswanger and translated by Binswanger. All aspects cited here, from Marx to Solow, suggest that growth is possible and explicable, but they do not address the causal foundation that drives it. And as Susskind wrote, there's a kind of mysterious about the foundation of growth. I'm not quite sure if Susskind even is convinced that he get rid of all mysteries. This leads to my research question, whose interim results I will briefly outline below. My research question about the causal basis of capital investment and its impact on growth does not aim to establish an independent growth theory. Although historical developments and controversies in growth theory I incorporate into my research considerations, but rather to focus solely on a microeconomic aspect that, if correctly understood, would provide a better grasp of economic reality and, in my view, improve the understanding of macroeconomic developments. To address just one element of the controversy, consider this quote from Krelle. If one, with Marx, views the distribution of the social product as fundamentally a question of power, and we have also actual books from Acemoglu about it, Power and Progress, that is a social and political rather than an economic issue, then the marginal productivity theory cannot be correct. However, it logically follows from the assumption of perfect competition and profit maximization under a neoclassical production function. If one questions the existence of a macroeconomic production function, then not only the marginal productivity theory of distribution, but also the entire neoclassical growth theory collapses. Quote ended. Although this does not influence my research considerations, it makes clear the unstable ground on which neoclassical growth theory stands, and my research aims to provide a theoretically still incomplete but practically very useful approach. Now to my research considerations. Starting from the fundamental functioning of an economy, we arrive at the basic concept of exchange, namely the exchange of goods and services, which constitutes a barter economy. With the introduction of money, among other things, as a medium of exchange, we can refer to this as a monetary economy. For the purpose of my analysis here, I'm assuming developed monetary economies as national economies with a legal system that protects private property, including investments and productive enterprises. A market economy with free access to a regulated labor market, leading labor laws, and a central bank that, among other things, safeguards the currency against inflation. These are economies at the forefront of global technology development, such, for example, as Germany. In particular, I'm considering developed capital markets where investments in productive enterprises, namely shares or stocks in corporations, are traded on nearly perfect market stock exchanges worldwide. I assume that approximately 2/3 of global social product is produced by such companies, which therefore collectively exert a significant influence on the course of the world economy. For an economy to begin and to continue to exist, continuous investment is required to enable the production of goods and services. These investments must naturally be financed. This investment and financing function is particularly evident in the development of startup companies. After developing sound ideas and so-called business plans, rounds of financing take place to fund development, production, and sales through investments. Financing and investment do not occur, nothing happens, and hence no economy exists. But why should financing and investment take place at all? I would like to derive this initially solely from the capital market or stock market. For shares and productive enterprises, as these clearly and distinctly separate ownership, financing, from the management of the productive enterprise, execution of investments. It should be noted that financing by a stock investor is always also an investment for that investor, even though the financing was undertaken by a previous owner, and through the acquisition of the stock, the subsequent investor effectively assumes the financing initiated by the first in economic terms. So what is the driving force or fundamental basis for a stock investor to invest in a stock or to finance a productive enterprise through stock ownership? In other words, what is the conditio sine qua non, the essential reason for making such an investment under rational considerations, even though there may be many or other factors at play? To answer this question, an analysis of the stock's functions is helpful. A stock, first and foremost, grants ownership as a transferable share in a productive enterprise, typically and assumed here without direct influence on the enterprise itself. The other function is value orientation. A stock has a price, and it may yield annual dividends, but its price can only rise, remain stable, or fall, nothing more. Since one of these three alternatives always applies, the question is which outcome the investor always desires. And rational consideration can only be the continuous increase in the stock price. Otherwise, the shareholders would harm themselves if they opted for a stock with a stable price, gaining nothing while risking everything, disadvantages, or a declining price, while the loss, highly disadvantageous. This desire among shareholders is reflected in the behavior of capital markets. Overall, one remains invested in a stock only as long as they hope and desire for the stock price to increase continuously over time. Dividends are already factored into the stock price in a perfectly competitive or almost perfectly competitive market. They have, so to speak, already been paid for. The actual gain is the increase in the stock price, or, yes, dividend grows beyond expectations. For clarification, consider this example. If a stock's price has risen significantly, the shareholder will still and always desire future price increases as long as they remain invested. This desire is carried forward by each successive shareholder. That the desire for stock price appreciation never ceases and is permanently present. If we can assume that management aims to fulfill this continuous desire of shareholders or owners for stock price increases, otherwise board members risk losing their positions, the question arises of how this can be achieved on an ongoing basis. There is a simplified formula from financial theory that describes potential value increases with the hope that these will eventually be reflected in the stock price in the medium and long term. In a more simple form, market value added, and here I excuse when I just read about the formula, but you will soon have them in text. Market value added, what it means, the added value on an invested value, equals net operating profit after tax minus weighted average cost of capital times invested capital divided all by the weighted average cost of capital. Without delving into the details of the analysis, it can be deducted that all conceivable variables, NOPAT, so the net operating profit after taxes, WACC, weighted average cost of capital, invested capital, when changed can lead to an expansion of the market value and thus potential stock price increases. However, some of these are constrained or even mathematically limited. Assuming the average weighted cost of capital is greater than 0 as a premise, and that the invested capital is considered constant for an indefinite period so far, only an increase in net operating profit after taxes and or a reduction in the average weighted cost of capital can lead to an expansion of market value and potentially an increase in stock price. As briefly explained before, this should occur permanently, i.e. indefinitely over an endless period. If the premise is assumed that only positive rational numbers are used in calculation, i.e. no negative capital costs, no negative invested capital, no negative revenues, and no negative expenses, but a negative operating result after taxes is conceivable if expenses are greater than revenues. One can mathematically and logically arrive at a permanent market value expansion and thus a possible permanent stock price increase only if perpetual revenue growth is possible. Expenses contribute to the reduction but are not further deductible when at 0, so they drop out for permanent value increases. And this is required if permanent value growth must be achieved in order to remain invested. However, if revenue growth reaches the capacity limits of the invested capital, further investments are required, which can again be financed through equity, shareholders, or debt capital, previously only implicitly assumed through the weighted average cost of capital, with more detailed explanations in my coming text. In order to generate further market value increases and potential stock prices increases. The transformation of the above formula can illustrate this well. I just give you the final form. So market value added equals return on invested capital minus weighted average cost of capital times invested capital divided by WACC, weighted average cost of capital. Even based on this formula, a permanent expansion of invested capital, provided it is accompanied by positive ROIC, positive NOPAT relative to invested capital, and a lower WACC, weighted average cost of capital, known as the return spread, occurs in such a way that the market value expansion and a potential stock price increase are permanently present. This is mathematically and logically possible only with a permanent increase in revenue and also in expenses, meaning that with high invested capital, an increase in revenue must always be achieved under the aforementioned conditions. I subsume this constellation as the term business expansion. This permanent revenue expansion or business expansion with unconditional additional revenue or more is invested is then the fundamental conclusion for the root cause of permanent value increase when staying invested in shares or stocks or productive companies. Quote, erat demonstrandum. This financial mechanism, assuming rational behavior of the presumed predominant majority of market participants, leads, as a hypothesis, is a successful case of a quantitatively determined majority of globally distributed capital markets and stock exchange financed productive companies to a constant expansion of revenue and the gross domestic product of the global economy. Historic data show this. No falsification of this hypothesis has been found or achieved so far. I want to admit that I'm also looking right now for capital markets in the development from the times of 1800 before up to our times, if there can be a correlation of the capital market as seemed to be so important, the crystal clear cause-effect line I just described. Or to put it briefly and concisely, Capitalist economic systems, if successfully implemented, lead to a constant expansion of revenue and GDPs of all capitalist-oriented national economies, i.e. to permanent overproduction and sales in quantity and or quality. The historical data confirm this hypothesis. As long as this happens, for example, with a permanently increasing additional energy consumption through the use of fossil fuels, carbon dioxide-induced climate change is inevitable. Since the capitalist system approach analyzed here is necessarily conditioned, only international legal regulations can stop, for example, the undesirable climate change. Trust into the participants of the capitalist system and market-based adjustments are illusion. I want to remark here again Solow and Roma, who build up their growth models mainly on technical development, or Roma even indigenous with the idea development. I do not deny these models. I would even support them with my idea. It's just more fundamental what I described here, how to come to the neoclassical growth models. And when we see now very clearly that the fundamental cause is the necessary possibility of rising stock markets forever, which leads in the end to rising sales and GDP forever, as long as possible, and necessary for capital investments, we can clearly see that cannot solve the problems of the capitalist systems, because if we would change this condition, the capitalist system wouldn't function. And if we also see that the capitalist system brought us the wealth, or the wealth of nations, for so many people on this planet, even we have these negative outcomes we have to solve. We have to solve the problems not economically, or we cannot even solve them economically. We have to go back and bring back these questions, these problems to society and politics and parliaments, to make rules which clearly give the way and the direction for the, in other ways, successful capitalistic system. At the end, one example, slavery. As we know, for centuries or thousands, over thousands of years, cultures in the world, slavery existed, and it was seemed to be very important, and it took a very long time to abolish, to finish this horrible institution. But this was not done by economic forces. It was done by the will of the people, especially in the United States, through war, the Civil War, and the famous president who won this war, Abraham Lincoln. Yeah, with this little, maybe extreme example, I say goodbye. Thank you very much.